Very good afternoon, good morning. Welcome to live market analysis with myself, Giles Coughlin, Chief Currency Analyst. Very good to be with you today. Hope everybody is okay. If you can just let me know you can see my screen and hear my voice okay, that would be great. Hi Cameron, Johan, Selva, good to see you. Vitez, looking forward to just taking us through markets at the moment because we're seeing some pretty interesting dynamics going on. Yeah, thanks Johan, that's super. And it's just going to be important to make sense of what we're seeing today. Tricky market conditions with some pretty accelerations being seen in risk-off trading. So I'm just going to run through why that risk-off trading is here, what's likely to cause it to shift, and how this is going to impact the Federal Reserve meeting this week, as well as looking roughly at what we can expect. So quite a few different moving parts. Tricky market conditions today. Just as other folks are signing into the webinar, very good morning, good afternoon to you. Don't forget, as we talk about different entries, exits, this is all from an educational perspective. I'll show you how I'm handling markets at present. And these are the major issues we're going to be looking at today, looking at the US dollar, obviously all eyes on the Fed. We'll be looking at gold in particular, SNB and the Bank of England meeting this week. SNB has some concerns about strengthening Swiss franc, so I'll just be outlining what's going on there. Also be taking a look at the Bank of Japan and CPI in general focus. I'll just explain some observations that I've noticed on the CPI front. So that's roughly what we'll be covering. So without further ado, I will move us over to the main screen and just have a look there. Let's just check that's the right, yeah, that's the right screen. Okay. So a couple of things to note. We can see dollar strength in markets today. The reason for the dollar strength is the risk-off trading that we have going on. Now, the reason for the risk-off trading is due to a company in China called Evergrande. It's the second largest property developer in China. And they have, nearly 300 property developments in nearly 300 cities across cities and regions rather across China. So a huge company, and they're in sort of billions and billions of dollars worth of debt. So the current fear is, will the People's Bank of China, the current fear is, will China allow Evergrande to collapse? And that's why we're seeing risk-off trading going on. Now, remember the dollar. The dollar sometimes responds to US economic issues. It sometimes responds to risk-off trading. And when trading's risk-off, we see bids into the dollar. This is a classic risk-off market, and we'll just go through it. So it's good for your learning if you haven't already grasped this. We're seeing downside in commodities, downside in crude, downside in copper futures. We've seen general pressure in natural gas, although broadly speaking it's been very bullish, and that's been all over the international media. We're seeing downside in iron ore. We're also seeing downside in Bitcoin. Now this is clearly on risk-off trading that we're seeing at the moment. So commodities are weaker. We're also seeing bids into bonds. So you can see yields pushing lower. That's partly what's helping to support gold. With yields pushing lower, that means that gold and silver isn't pushing lower as well. So even though the dollar is strengthening, which would typically weaken gold, but the fact that yields are moving lower just means that the real yields are sort of moving sort of a little bit sideways. So that broadly is, at least not catastrophically lower for gold. We can see some pretty heavy selling going on here in equity markets. Look at the S&P 500 down, NASDAQ, DAX, FTSE 100. This is accelerating selling. VIX spiking higher above that 20 region that had been containing prices last week. We're now heading up towards 28 and 32. Some pretty strong risk-off sentiment being seen in equity futures markets. We can also take a look at the risk-off currency pairs. We can see, New Zealand Swiss franc lower, CAD Swiss franc, CAD yen, New Zealand yen, Aussie Swiss franc, all lower on the session. Medium term, there are opportunities for New Zealand dollar, Japanese yens, here at market, and also medium-term opportunities at New Zealand dollar Swiss franc at that 0.6475 region. So if this moves much lower, do expect to find buyers up into that support level, because the RBNZ generally won't see interest rate hikes. They're projecting 1 hike this year, 4 next year. So broadly speaking, this short-term negative sentiment is a good opportunity to potentially buy the dips in New Zealand dollar Swiss franc and New Zealand dollar yen. New Zealand dollar yen can be bought from market. Stocks just underneath 74.50, but we'd anticipate that to find some dip buying once we start to see the risk-off tones just decelerating. Taking a look here at the pound yen also, that's a good area for potentially buying, so can expect buyers from market in the pound yen. And this is the risk-off dynamic that we're seeing. Weakness in Aussie CAD New Zealand dollar, and strength in the safe havens, yen, Swiss franc, and the US dollar. So it's a very clear risk-off market that we're seeing at the moment. Now, the reason for that is that Evergrande concerns, and also a lot of Asian markets on holiday at the moment, Taiwan, Japan, South Korea, so there's less liquidity, which just leads to an acceleration in the risk-off trading. Now, what could turn this around? There's a few things. One, if China bail out Evergrande and decide to support the company, then we'd likely see a sudden turnaround in risk sentiment. Conversely, on the other hand, if China allow Evergrande to fail, and they might, because they might want to send a lesson to the rest of the market. Remember, economists speak of something called a moral hazard. Now, a moral hazard is where you support a company so much that there is no risk of it collapsing, which means investors, speculators, and the company itself can take extreme risks, and they do so because of the moral hazard, because of the fact that a company will always be bought out. So if China, are thought to always bail out every struggling company, then that creates a moral hazard. It could mean that companies within China take big risks, because they say, well, if it goes wrong, it's okay. The Chinese government will bail us out. So China might, they might make an example, of Evergrande. So do watch out for that. It's definitely something to be looking for, and definitely something to keep a careful eye on going forward in the weeks and a few days ahead, rather. So do keep that on your agenda, nice and prominent. Okay, so that's the key thing. Now, on the weekend, on Wednesday, this is a major event that we have. Do check out Top Trading Opportunities. It's all going to be about the dot plot for the FOMC. Okay, so this is the dot plot here. And on Wednesday, when the FOMC meet, the major focus is going to be, what do the Fed project going forward? Now, you remember in June when they met, what they suggested was that interest rate hikes would be coming at 2023. That was a shift from 2024. Now, September's meeting, the meeting that's due this week, if we see more dots moving from the left, moving from the right here to the left, that will mean that interest rate hikes are expected in 2022. So we currently have 7 dots here. If we move just a few more dots over to this level, if we see just 3 members moving to 2022, that will mean the median time for a hike will be 2022 rather than 2023. So that itself could boost the dollar. So watch out for that come Wednesday. Now, the expectations is that the Fed won't taper this month, but they might signal tapering next month. Now, the big issue that the FOMC have is jobs. The Fed wants to see jobs return to pre-pandemic levels. And can you see that current levels of jobs are roughly half what they were before the COVID-19 pandemic? Now, why are the jobs not occurred? Is it because of the job furlough scheme? Is it because some people have chosen to take retirement? Is the job market just smaller? These are some of the questions that the Fed will want to answer. So two things. One, if the Fed announce bond tapering tomorrow on Wednesday, that will be a big shock. But expect them to give hints about it coming in November, because they have said that they will, with plenty of notice, announce when they're going to taper. So expect some hints about November tapering. If they taper on Wednesday, that would be a big bullish shock. Look for commentary about jobs. They still want the labour market return. Look for the dot plot, because that could show you that the board members are maybe more bullish than the statement portrays. So there could be some mixed messages coming out of this meeting. Definitely want to look out for. The hawkish outcomes is if we see the dot plot showing a 2022 rate hike, in which case expect weakness in gold, upside in the dollar index, downside in stocks, upside in yields. If they open up the possibility of a November tapering announcement, that should be supportive of dollar gains. Again, you think you'd expect majors to be lower, you'd expect dollar index to be higher. If they're more concerned about persistent price pressures, inflation, etc., expect that to boost the dollar as investors expect earlier interest rate hikes. And if there's no concern over the August non-farm payroll, now remember that August non-farm payroll saw 250,000 jobs added versus 750,000 expected. So it was a big disappointment. Now, if they say we're not worried about that, then that's all dollar supportive. Now, my expectations, which of course could be wrong, but I'm expecting a dovish outcome. I'm expecting to see the concern over jobs. I think they could easily talk about tapering being premature. Now, particularly if, now look at this, this is something to watch. Now, look at the equity markets. They're really moving lower quickly, okay? If this risk off really accelerates, then will the Federal Reserve spook markets by talking about tapering? No, they'll be more likely to be on hold and take a wait and see approach. So if this Evergrande situation kicks off and Evergrande's allowed to collapse, expect a sudden fall in equity markets, but I'm expecting dip buyers. So some areas where I can see good value for dip buying, I can see good value here at market, stops below 6767. I can also see good value here in the DAX with stops buying at market with stops below 14765. Looking at the Euro stocks, again, I can see good value from 3956, just underneath that 4,000 region, stops just below that 3888 region. Medium term, we still do expect upside in stocks. Now, a 5 to 10% correction has been expected in equity markets for some time. So it's not a surprise to see a correction. The obvious places to go medium term long is 4260 in the S&P 500. And that 4112 region, that 4100 region, if you just look at the 200 moving average here, if I just we look at this as the 200 moving average, you'll see that the 200 moving average is a really nice level there, just above that 4100 region. So I would expect medium-term buyers from there, and particularly that 4000 region would be an ideal area to potentially go long on a medium-term basis. So yes, we're seeing short-term selling going on in markets at the moment, but medium-term, the bias is still to the upside. We've got low interest rates, we've got broad fiscal stimulus. The Fed haven't yet signaled coming interest rate hikes, so we should expect medium-term equities to be supported. But deeper pullbacks offer better value. The reason for the sharp fall in the equity markets is risk-off trading on concerns that Evergrande will collapse, and it will be a domino effect across the global indices. Now, some people are fearing that the Evergrande property debt crisis will be another Lehman Brothers. I think it's unlikely to be, because the difference between Evergrande and Lehman Brothers is that Evergrande involves property, and the property which Chinese consumers buy require large deposits. So there is a lot of money against the properties that have been bought. So there is access to that money. It's not like all the money, all the debt is just going to suddenly disappear and there's no capital in the system at all. There is capital in the system that should be supportive if we start to get a significant fall in equity markets. And of course, China, they might cut their reserve interest rate. They might do that overnight. As they come back from holiday, wouldn't be a surprise to see them intervene. So I'm expecting this dip to actually be bought and to recover. Now, of course, I could be wrong, but if that's the case, places like this region offer good value. That's good value, that 4263. So look out for a turnaround Tuesday in stocks for sure. Yeah, so S&P 500 breaking the last higher low on the daily time frame. Schwa, yeah, that's right. So that would be a dovish development, and it's on that risk-off trading. But this is also key support. So a very sort of, you're seeing a little bit of tight. Some people just testing the waters here, just buying in at this level. So just watch out for what goes on there at the moment. Watch out for any headlines about Evergrande. If China step in, then we'd expect this risk-off trading to suddenly reverse. Remember, all eyes is going to be on the Federal Reserve for Wednesday. So at some point, these falls should kind of flatten out a little bit. And also keep your eye on the VIX. If you want to see what's happening in equity markets, just keep a careful eye on what's going on with the VIX. This level here is a key region. We can just see the VIX coming into this possible trend line, seeing a few sellers leaning against that possible trend line. If we can sort of close below that level, then that may be enough to start to see equity markets just recovering as well. FTSE 100, medium term, that's good value. I would expect to find buyers from that region. And if I had to take my pick of which stock market to trade, I would try the FTSE 100 at market, stops below 6771. That is a trade I'm in, and I'm looking at that level. Now, if that level collapses, then fine, take your stop, take your hit, and then look at rejoining here about that 6500 region. But otherwise, that's a pretty solid level. And as we head into the FOMC, the worse it gets out of China, I think the less chances we're going to see the Fed move, if that makes sense. So a tricky day, okay? Nothing to get overly worried about here. I think if Evergrande do collapse, I would expect those dips to be bought, but that's the thing to be looking at as we go forward into the session. New Zealand dollar yen, that's a great value region as well. I like that from a medium-term bias, just buying at markets, looking for that trend line to hold. You can see some buyers leaning against this level. RBNZ, remember, expecting 1 interest hike this year, 4 next year. Bank of Japan, they're meeting this week, not expected to have any changes, so expecting buyers at market. That's a great value area. You can just keep stops below here. If this market closes below the trend line, then you'd expect to find, you can exit the trade, stay above, stay with it, get back below, get out, stops below 74.50 just to be on the safe side. That seems a reasonable way to do it. Quick look at SONIA futures. This gives us indications of what's happening for the Bank of England on Thursday. We'll look at this and look at that in some detail. But just to let you know that here for September, we've got SONIA futures at 99.57. So current interest rates is 0.10. So that means 3 basis points rate hikes, 30 basis points rate hike expected for the Bank of England by September 2022. So markets are expecting interest rate hikes coming from Bank of England. First one expected here in March, 99.78, February time. So current interest rates is 0.10. So the way you calculate these SONIA futures, you take 100, take away 99.78, that leaves 0.22. minus the current basis points of 10, that's 0.12. So it means there's one interest rate hike expected between now and March of next year. So we'll look at that in some detail. Another little expecting buyers at pound yen makes sense. Stocks just below 148, so ahead of the BOE. That's quite a nice region to go long. Also the Aussie New Zealand dollar. If we see the Aussie New Zealand dollar moving low into that 1.10100 region, I would expect to find a retracement. Okay, yes, we're bearish Aussie. Yes, we're bullish New Zealand dollar. But I expect to find profit taking down, a bit of mean reversion if we move into that 1.0173 region. So look out for that on the Aussie New Zealand dollar. So yes, markets are tricky, but watch out for them. US dollar CAD. Yeah, we expect medium-term downside bias in US dollar CAD. That's a good area potentially shorting the US dollar CAD ahead of the FOMC on Wednesday. So look at that region as well. Definitely a decent region, lots of resistance. Right, we'll quickly have a look here now at the calendar. Calendar here, we can see very light on today's calendar. We'll just get to today's date. Let's just refresh that. Okay, here we go. So first thing, CAD federal election. Now, Justin Trudeau is expected to have to share power in Canada. Here's the result of the latest poll. You can see that the Trudeau's Liberal government is in a dead tie with the Conservative government. So it looks like that the Liberals are not going to get a majority, there's going to be a power share. So it's going to come right down to the wire. Not expecting that to be a huge mover for the CAD at the moment, but just to be aware that that election is going on with potential for some volatility. There isn't anything obviously tradable at the moment on that. China's still on holiday tomorrow, but look out for any surprise announcements. Australian dollar monetary policy meeting minutes. The outlook from the Reserve Bank of Australia is that the COVID-19 outbreak has delayed but not derailed the recovery. A lot of people are bearish the Australian dollar. I'm expecting some mean reversion. If we get a very dovish Fed on Wednesday, wouldn't be surprising to see some mean reversion, maybe Aussie US dollar upside. I would favor Aussie New Zealand dollar upside if we drop lower into that support level that I mentioned. Even though the outlook is pretty bearish, we've got slowing China growth, we've got iron ore prices that have kept moving lower, copper prices moving lower, all of that a negative headwind for the Australian dollar. But a lot of people have been selling Aussie, and there is some mean reversion that's due. So that's what I'll be looking at for the Aussie. Anything in the meeting minutes that show more optimism or more hawkishness, that could see a bit of a correction in the Aussie dollar. Not expecting it, not something I'm trading, but something that, to be aware of going forward. Quiet again, apart from that meeting minutes on Tuesday. Wednesday, we have the big event, the FOMC statement and press conference. We also have the Bank of Japan press conference. Nothing expected here from Japan. They should keep interest rates very low, no change expected. So, trades like the New Zealand dollar, Japanese yen, New Zealand dollar, Swiss franc, pound yen, all of that should be supported. And there shouldn't be any surprise from the Bank of Japan. Interest rates expected to remain exactly the same. Low interest rates, negative interest rates. So the rate differentials mean you'd expect New Zealand dollars, Japanese yen upside, pound yen upside. We've covered the FOMC statement. Come back on Wednesday. I'll go through it in depth, what we need to get ready for that. For me, it's all going to be the dot plot. That's where the detail is going to be most important, most likely. If we see rate hike coming 2022, don't be surprised to see some further dollar strength. Watch out for that. If we see more risk-off trading, then watch out for the Fed staying on hold because they don't want to spook markets even further. Thursday, couple of significant events. SNB monetary policy assessment. They're expected to keep their interest rates minus 0.75%, the lowest interest rates in the world of major central banks. They've recently repeated that they want to keep interest rates low. They hate the Swiss franc gaining in strength. So the Swiss franc getting stronger will bug the SNB. If the Swiss franc gets even stronger, then expect the SNB to say something, maybe even do something. And remember, the Swiss National Bank will intervene in the Swiss franc by buying euros and buying dollars to weaken the Swiss franc. So I wouldn't be surprised if we saw some jaw boning, saw a bit of action from them. Now, we also have the German Manufacturing and Services PMI. That will be important just to get the trend of what's going on in the Eurozone. Are we starting to see a German recovery? Remember, Germany is the most important nation for the Eurozone. It's kind of like the engine house. It's the manufacturing center, and it is also the largest contributor to the Eurozone in terms of GDP. So as goes Germany, so goes Europe. Germany's data is traded, the euro is traded very closely alongside German data. So a big surprise here would be positive for the euro. But remember, we've got to digest what happened in the Fed in the night before. Looking at the pound, this is going to be interesting. Now, a couple of things with the pound is, yes, the outlook is been growingly more optimistic for the pound. We saw that with the SONIA futures earlier, didn't we? One interest rate hike expected in February. But how will the MPC, the Monetary Policy Committee, judge the UK economy to be? Now, inflation was a bit higher recently, but it was still only at 3%. And remember that the Bank of England themselves projected inflation to be at 4%. So I don't think they'll be worried about inflation, but they may be worried about the labour market. The UK labour market, the furlough scheme, which was to support people out of work due to COVID-19 or unable to work, comes to an end in October. So the Bank of England might say, we want to see how that furlough scheme works. We want to see what the state of the job market is once the government support is withdrawn. So I could see the Bank of England being on a more cautious and a more tentative note. Broadly speaking, I'm expecting them to keep the more bullish, hawkish, optimistic outlook in place. The general data around the UK has been pretty robust. We have had a reopening and a withdrawal of some travel restrictions, international travel requirements for UK vaccinated citizens. So that is a more positive note, but it remains to be seen. There's a balance of risks here. Exactly what the UK do, and they tend to be more dovish, and they try to rest on the cautious side. So if they are more hawkish, expect the pound to rally significantly higher. Something like a pound yen would be very interesting on that. Friday, we've got Jerome Powell speaking. Now that's worth looking at, because when Powell speaks, he has opportunity to address anything that was misunderstood after the press conference. So after the press conference, that's when Jerome Powell really clarified what was going on in the statement. And then there'll be a couple of days of market price action, but Jerome Powell has another opportunity to redress things if things are not going in the right direction. So that's kind of a hangover from the press conference. Folks, it's a trick. These are tricky markets at the moment. So if you could just let me know if you've got any questions. Please type them in the Q&A box. Don't forget, on Wednesday we're back here to look at the FOMC. For now, probably what you want to keep your eye on is the VIX. So I'll just show you the market here. This volatility index. If this starts moving lower, that's going to be more supportive for stocks. And stocks are most likely to be freaked out by this Evergrande problem. So watch out for that. Okay, Schwa, gold picking up momentum. Now, I'll show you what's going on with gold. Now, remember, when real yields fall, gold rises, okay? So falling real yields rising gold. You look here, when you see falling real yields, rising gold. So you see here, November 2020, as real yields, the red line falls and the dollar falls, gold rises. At the moment, we've got real yields, they've kind of been flat to sideways, and we've got the dollar strengthening. So real yields are rising, dollar strengthening, that's been pushing gold lower, okay? So when we see real yields rise, and when we see the dollar strengthening, like we did in February 2021, that's when we see gold fall. So that's the pressure that's going on to gold at the moment. But what's happening is 10-year yields today are falling lower. So if we just go over to the US 10-year yields chart, you can see 10-year yields are pushing lower. That's why gold is just able to find a tiny bit of support today. And what gold's looking at is the FOMC event. Now you can see here, this is an inside, Harami inside bar, and this is looking like a false break of a Harami inside bar. So if this closes at market or higher, then expect some traders to go long on anticipation of a dovish Fed. If the Fed are dovish on Wednesday, and if they say, look, you know, we're not going to hike, we're not going to taper bond purchases this year, we don't see interest rate hikes coming till 2023, we're concerned about the job market, we're concerned about slowing growth in China, if they're dovish, bearish, that would sink the dollar, sink US 10-year yields, and gold would absolutely fly. This is the trade that I am really interested in. Do you see this 1 week chart here? You see that bullish pin bar there? Do you see how that is the best looking technical pin bar on this chart going back for like 13 years? Since 2007, I cannot see a better technical looking long than this. Now, it doesn't mean it's going to work. We want to see the fundamentals in line with the technicals, but technically that is a beautiful rejection. Do you see how the body of the hammer is within the body of the previous day candle? Important. Do you see how the tail of the hammer is long? Important. Do you see how there's space to the left? Important. Do you see how it's rejecting a key trend line and a key horizontal support level? Important. All of that means if we get reasons for weakness in the dollar, reasons for weakness in 10-year yields, we'd expect gold to absolutely rip higher. So this could be a very cheap, good value place in here, okay, with stops just below that 1741 region. Looking for this to go higher, get above that trend line, get a dovish Fed, and expect this to rip higher. There's some really, now I don't know that'll happen, and it will depend on the dovish Fed. The technicals are good. We just need the fundamentals to make it to put into line. So it's not so much that gold's picking up momentum. Gold is still, pressured to the downside. Why? Because real yields are moving higher. The dollar's been moving higher. That keeps gold pressured. But we're seeing a little bit of bounce because US 10-year yields are just coming off those highs, right? So you see the yen, there's bids into bonds. That is broadly supportive of gold. That's why gold is just finding a little bit of a bid. But look, to see the bigger picture, look, oh, gold has been selling off. Does that make sense, Shwa? So what we need to see, 30 minutes break of structure. Let's have a look. I mean, there is, if you wanted to get clever intraday, then like, any retest down to that 1750 could be suitable for longs. There's a break of an intraday trend line, get back above that R1 pivot zone, you'd favor more buyers. You'd expect gold to move sort of flat to sideways now, unless we saw a really strong bid into bonds. If we saw the dollar, if we start to see the dollar selling off, and you see dollars in a key resistance level now here as well, just up at that sort of 93.60 region. You see this key resistance level here. So if we start to see dollar moving lower as well, if we've got the dollar moving lower, US 10-year yields moving lower, then we could see a bit more upside in gold. Okay. But remember this relationship, Shwa, and like you've got to have this in your head, which is when real yields fall and the dollar falls, gold rises. Here we had real yields falling, but the dollar rising, so gold was quite flat. And at the moment, we've got real yields rising, dollar rising, gold falling. That's the context. But at the moment, intraday, we've got real yields just dropping a little bit, and we've got the dollar just dropping a little bit. So that's why gold's able to find a little tick. Now, if this moves lower again, then gold should be able to put in a bit more of a recovery. So I hope that makes sense, Shua. But you're looking at the interplay between real yields, the US dollar, and that's the key thing to really grasp. Okay, folks, been a pleasure. Hope everybody's okay. We've looked at some medium-term trades. Yeah, good, Shwa. Good man. Well done. You've noted all that. That is good to know. Take care, and don't forget, come back on Wednesday, and we'll look at these things again, and we'll look at gold in more detail on Wednesday as well, so we can get a potential strategy for it. Look after yourselves. Be careful out there. Make sure you manage risk, particularly with markets like this. If Evergrande do collapse, there'll be a heavy sell-off in equities, so be prepared to know how to deal with that. Take care, everyone. Goodbye.